Welcome back to Chart This. I'm Jeremy Szafron. Well, gold is under pressure today after the June CPI report came in just hot enough to rattle markets and reset expectations for Fed policy. And the dollar is surging. Treasury yields are climbing, and the S&P 500 has reversed earlier gains as traders now bet that the Fed will hold rates steady. Headline inflation rose 2.7% year over year in June, with core CPI holding at 2.9%. That marks the fifth straight month core inflation has come in softer than expected, but signs of tariff-driven price pressures are starting to show up. Now, meanwhile, gold dropped $26 intraday to around $33.30 an ounce on the spot side. Silver pulling back sharply to about $38 just after hitting that 14-year high last week. Now, the next few sessions could be critical for precious metals. Let's look at the charts, and later we're going to take some of your viewer questions. Joining me now is one of the best in the business, Gary Wagner, of course, editor of thegoldforecast.com. Good to see you, my friend.
Thanks so much for having me. Summer trading is absolutely here.
Yeah, you're not kidding. Just watching it today, it was interesting watching some of these moves because, Gary, gold sold off about $26 on the CPI print, down to $33.30. The dollar's ripping. Walk us through the technical damage, if any. Are we still consolidating, or was this the trend break? What are your thoughts?
Well, today on our daily charts, gold is close to breaching the 50-day simple moving average. And the simple moving average, the 50-day, is a important average that us as market technicians use to determine whether or not a stock or commodity, and we're looking at gold, of course, whether gold is in a short-term bullish trend. Above that moving average, we consider gold to be in a short-term bullish trend. So that's an important one. We look at the 200-day really for a much, much longer-term view of the market. That's why I don't have it up. But if you see on the chart right now, we do have, let me blow this up a little bit for our viewers. But as you can see, gold is trading just under the 50-day moving average. The simple moving average is at 33.46. And of course, gold right now is at 33.3780. And this is basis the August futures contract. So that's important that our viewers note that this is not spot that we're looking at.
Mm-hmm. Yeah, no, you said it. I got the spot numbers just because obviously we got the Kitco charts. And it feels like it almost kind of rejected that 33.89, 33.90 mark this week. Is $3,300 still the floor on that side, Gary?
Well, 33 is absolutely the floor. We're at 33.37 in futures. So spot is going to be a few dollars below that. But if you notice, we had the all-time record high. That was hit on the 16th of June. That is when gold actually surged above 3,500 or close to it, 34.75 on this chart. It came down to a low of 32.48. But the key was today we did see gold break through that simple 50-day moving average. And the key is, if we look at a more long-term view, and let me go ahead and bring this chart into perspective, you can see for the longest period of time, we had gold well above the simple 50-day moving average since really January of this year. It touched during we only had really a couple of corrections here, this correction middle of May, and then this more shallow correction at the end of June. And so you'll notice that on every occasion when gold did correct hard, it found support at the 50-day moving average. Again, right. Find support at the 50-day moving average. So the fact that we've broken below that is alarming on a technical basis. When we see that, then we're concerned that we might see gold fall further. Effectively, a close below the simple 50-day moving average could bode for lower prices. But if you notice, throughout the entire year, it stayed above it. And the one time that it came down below it, beginning at the middle of June, we hit this high at around 34.70. We broke below it, but in terms of trading days, 1, 2, 3, 4, 5, it only stayed there for 6 trading days, came back below, it stayed there for 4. So it has been meandering below that and then finding some footing above that. Once again, we're in a situation where gold is trading just below the 50-day moving average. And that's something that could be alluding to softer prices over the next week or 2 weeks.
Interesting. I mean, you mentioned it off the top. We're going into the summer months too. That could be a little bit of that. But what's the next line in the sand? I mean, 3,300, 3,280. How critical is that level for the bull case to kind of hold?
Well, when we look at the chart itself, the low that came in on the 27th and Friday the 27th, and then on Monday, June the 30th, came in where it just was the lowest we've seen. Now, we've had a series of one higher low, and we've basically had a triple top, and that triple top has been absolute unbreakable resistance. That is the gold bar. That is what we want to see gold test again. It's tested it or close to on 3 occasions since April. So that's really if we're going to make a case for gold running in a bullish manner, it really has to tackle, challenge, and effectively on a closing basis move above this line here, which comes in at around, call it 34.65, and that's this triple top here. The fact that it broke below, we've seen it kind of challenge that before, but in each case, it's been short-lived, but it also was short-lived. It didn't effectively move back up into the channel. So right now, I've got a resistance line from this high here and the top of the real body here, the candle that formed on Monday, the 14th of June. And so that is a hard line in the sand that we want to see gold break above. In terms of downside, 3,300 is a strong area. You can see that it was a supportive area through the last week in May. And so it is an area that we want to see gold effectively hold above. And right now, that price point is also where the simple 50-day moving average is. You've got those two right at the same price point. So it makes it a stronger area in terms of a level that we want to see held. Right now, gold is not, but it's only flirting with it by a couple of dollars. So we'll have to see how that kind of unfolds throughout the next week or so.
Yeah, good point. And I mean, the resilience of it all year has just been incredible to watch. Okay, Gary, I mean, we've got to talk about dollar surge. The U.S. dollar index rallied hard after the CPI print. How do you interpret the dollar's move technically? And what's the risk to gold if DXY holds this strength?
Well, obviously, because there is 100% correlation, because gold is paired against the dollar, any upside move in gold converts to the same percentage decline in gold. And so, for example, today, I believe we have the dollar up about 0.5%. That's this daily candle right here. And then if we switch real quickly to gold, that's down about 0.5%. So in actuality, what we're looking at right now in terms of what gold did today, it was fairly neutral in terms of market participants, traders actively bidding it up or selling the market. And I would say about 95 to 98% of the net change in gold prices today is all related on dollar strength. And we can see that it has been in a strong upward move really since the beginning of July. It was at around 96. Now it's trading at 98, so it's gained about 3% in just this month alone. So it's been very strong recently. The resistance is obviously going to be this 50-day moving average. And if we compress that, you can see that the 50-day simple moving average has been strong resistance for the dollar as it sold off all the way down.
Yeah.
And so what we want to see now is an effective break above this 50-day moving average would signal a return to dollar strength. Right now, we have the beginnings of a strong rally, but we're not there yet. It's only been about maybe 10 trading days that we've seen the dollar bottom, and it bottomed at 96.40, rounding it down, and it's come up considerably, but still only about 2%. So the dollar's important. I also have our stochastic oscillator, which is a really good technical study to determine whether a market is oversold or overbought. And the way that we look at it is above 80 is a market that is considered overbought, and below 20 oversold. Right now you can see it came down, it hits this bottom here beautifully below 10, and that corresponds almost precisely with the low of the dollar. As the dollar moved up, so did the stochastic oscillator. It's not quite overbought yet, but as I said, 80 is the point in which we're looking at it being overbought and the potential for us to see a key reversal from bullish to bearish in the case of the dollar.
Yeah, I mean, I was looking at it and it's almost, you're wondering, is it just short covering rally in the dollar, or do you think that the sentiment is kind of truly turned?
Well, I think it has to do with the fundamentals and sentiments. A lot of it has to do with the tariffs right now.
Yeah.
And so the tariffs are playing a huge role and affecting the financial markets across all of the asset classes, whether it's equities, currencies, precious metals. Nothing is free from nothing is able to escape the power of tariffs right now. And in some cases, such as gold, we see it's put pressure on there. In other cases, such as the dollar, we see that it's provided the dollar with pretty strong tailwinds moving it up through the range right now.
Yeah, well said, man. Okay, well, we got to talk about the silver setup. I mean, it's been making a lot of headlines. I just got back from Boca Raton. Everybody there on the ground talking about silver. It's retreating from $39 to $38 today after a massive run. Is this a healthy consolidation, or is silver kind of flashing a deeper correction ahead?
No, I've got a weekly chart up just to give you an idea so that I can pull back, historically speaking, the last time that silver hit these levels. We've got to literally go back to 2012. And so it's been 13 years since we saw silver challenge $40 per ounce. So this is really significant. If you consider what it's done, if we look back in, let's say, 2020, we had this double top that came in, and that came in at about $34. It then traded to a low of 22, and then slowly moved back up to this current level. And we really have to go back, as I said, 12, 13 years to see a point in history when silver had this kind of value. Of course, what everybody looks for is these big moves where silver either challenged or breached $50. And we haven't seen that in quite some time. So now that we've got silver at around 40, the next real level is about $42 per ounce. That's the level we want to see taken out.
Look for 42. I mean, Garrett, do you expect silver to outperform gold in Q3, or are we kind of due for a reversion?
Typically, when silver is running, it tends to outperform gold, both in gains as well as corrections. Silver is a much more volatile metal in terms of pricing. So whenever it's running to the upside, which is what we're seeing now, it will outperform gold without a question. But the reciprocal is true. When silver is correcting, the percentage declines are much greater, much more robust than what you see in gold. So that is just clearly the definition of volatility, where you do get these big price swings or quick moves from one price to the next. Yes.
Yeah, great. Even if you put a little bit into the silver miners too, I'm sure if they continue at these prices. Okay, we got to take some rapid fire questions straight from our Kitco news community. I put out a question this morning. I said, listen, we got Gary on. Of course, Gary's our regular. What do you want to know? So thanks to everyone who submitted. We'll get to the first one. Earnhar said, for people who capitalize on preferable gold, silver, gold, platinum ratios in 2025, do technical favors averaging up in silver and platinum, or is gold lags enough to start reallocating? What are your thoughts?
My sense is, first of all, it has to do with the goals of the trade itself or the position itself. But my sentiment is you want to always have the availability to dollar cost average, so that if the trade has a long enough time scope and price scope, you want to be able to, if it moves against you, you want to be able to dollar cost average on the way down and thereby get an effective, better entry price. At the same time, you want to have clear and defined levels of absolute exiting the trade or absolute adding to the trade. In other words, if you're looking at silver as it moves up, you want to be able to dollar cost average on the way up to take advantage of those profits, but you don't want to be as aggressive in dollar cost averaging in profits as you do if it's moving against you. If it's moving against you, dollar cost averaging is one of the best tools you have, as long as it hasn't breached an absolute price point as to where you would have put a stop in the market. For example, this is where I would exit the trade. This is where silver's moved from a strong bullish cycle to either sideways or lower. And those are the points where you don't want to obviously dollar cost average, but effectively you want to have that tool to be able to capitalize and maximize profits if the trade is working for you immediately, or if it's trading within a range, be able to add to a position to effectively lower your entry price as you get in, unless it's hit your lower level target in which you would have said, no, I don't believe I'm still bullish on this market. And at that point, obviously, it's a point you'll want to exit. But strategically, you want to use that as a dynamic tool to effectively maximize profits when you're right, get a better entry price when you entered at maybe not the best opportune time, and take advantage of the dip down as long as it hasn't broken into a price point in which market sentiment has shifted from bullish to neutral or bullish to bearish.
Right. Yeah. Good advice from the master himself. Okay, we got time for a quick one more. We'll just be quick here. I mean, Herman, I got your name wrong, Herman. Herman TH, let's call him that. He said depth up to which DXY could test lower in the short term, and what are the medium term targets to the upside? We talked about this briefly, but quickly, what are your thoughts on that?
In terms of the dollar index?
Yeah, the DXY.
Yeah. Well, right now it's at a critical point. We want to see it break above the 50-day simple moving average. It hasn't done that all the way down. Effectively, I'm not going to be bullish on the dollar until we see it break above the simple 50-day moving average. And that would be the barometer that I use to gauge whether or not you can get bullish on the dollar again or not. Until it does that, it still could go much lower. If you look at what it's done really since February of this year, is every time it came to the 50-day simple moving average, that was a hard level of resistance, and it would move lower. We haven't seen the dollar index break above that, and that's the key. That's what I would look for on a technical basis to say that the dollar is finally broken out of this solid downward trend.
There you have it. Okay, last one to close us out, Gary, and you're allowed one non-market answer. What's your favorite anime movie? This is from Ben Jin.
God, I'm too old for that.
Too old for that. I like it. They'll be excited to hear it. Too many.
No, I
Too many.
wouldn't have a good answer if I knew them, but I'll refrain from answering that one.
Yeah, I like it. Okay, well, listen, I appreciate your time. I know that the markets are moving fast, but also summer action. It seems like we can almost take a little bit of breath here and watch not as much volatility, I see.
Absolutely. Absolutely. And I don't think that gold's really out of the water yet in terms of downside, but I've got to remain, as long as it remains really above $3,300 per ounce, I've got to remain bullish. But the fact that it went below the 50-day simple moving average, that is worrisome, because we really need prices to go back above there if we are to say that the bullish trend has returned. Right now, we can't say that. We continue to have a market that's defined by the narrow range and sideways trading activity through the summer months. That's all I can say, because that's what we're seeing.
Yeah, well said. Okay, well, we'll have you on in a few weeks, Gare. Always a pleasure. Appreciate it. I hope you're getting that nice Hawaii sun and a nice tan over there. Gary Wagner, of course, the Gold Forecast. Thanks, bud.
Thanks
Appreciate your
so
time.
much.
Appreciate it. All right, gold and silver are moving fast, and the Fed, inflation, tariff policy aren't calming markets anytime soon. Head over to Kitco.com for the latest charts and analysis, and don't forget to subscribe right here to Kitco News for expert interviews, real-time coverage, and of course the big picture perspective. Drop a comment below with your gold price target for August. We'll be reading. I'm Jeremy Szafron. We'll see you next time.